Hi everyone, this is Michael Kramer of Mock Capital. Today is October 1st. It's around 6:30 New York time. So we're going to start getting a lot more data this week. We've already gotten a lot of data to start. We saw some weak data out of Europe. We saw a flight to safety today, obviously, in markets with escalation of tensions in the Middle East between Iran and Israel. And that's creating a lot of turbulence in the markets. And we're going to see if we can't sort through some of it today. Tomorrow in the U.S., we're going to get ADP. We're looking for 125,000 jobs to have been created in September. Then on Thursday, we're going to get initial jobless claims. This challenger job cuts number could be an interesting number. You might want to keep an eye on it because this is a number that reports layoffs. And that may be an interesting number to see because of the, because of the nervousness there is about in the labor market right now. Also, we're going to get on Thursday the ISM services number. We're looking for 51.7 versus 51.5. Prices paid is expected to come down to 56.3 from 57.3. On Friday, we're going to get the non-farm payroll numbers expected to increase to 150,000 from 142,000. Private payrolls 125 from 118. Unemployment rate expected to remain unchanged at 4.2%. Average hourly earnings month over month expected to fall to 0.3% from 0.4. Average hourly earnings expected to stay at 3.8%, and the average weekly hours expected to remain at 34.3. And so this is going to round off what is going to be an important week because, again, everyone's focused on the economy and what's happening, and we're getting a lot of mixed data still. JOLTS came in better than expected today, but ISM manufacturing came in weaker, and the employment number came in much weaker than what was expected. And so this kind of is creating a lot of tension and frictions in the market, creating a lot of confusion. And so when we look at something like the euro today, that was actually weaker versus a dollar. It's interesting because when we look at the euro, take a little bit of a step back, you can see we talked last week about the potential bull flag that formed. We were also saying that the euro had gotten a little bit overextended. It might be able to break out and push to the upside. Apparently that obviously didn't happen. Right now we're looking at a retest of this breakout of the flag. Now, if this is a bullish pattern, we should be able to see the euro bounce off of this bull flag. If it is not a bullish pattern, then we're talking about the chances for the euro to revisit to this 109.5 area. Again, it's very important at this point that we do not break below this trend line because that's going to potentially signal that this was not a bull flag, right? Or we got some sort of false breakout and that we're not going to see the euro continue to extend. So very important to watch to see if this trend line holds going forward. When we look at the pound, that was also weaker today versus the dollar. The pound has really gone a really long way. Last week we had talked about the pound getting really overextended. We did come back down and touch the 20-day moving average. So right now this continues to be support. As long as the 20-day moving average continues to move up and the British pound continues to remain within the range of the 20-day moving average, such as in here, then the trend for the British pound, I would think, continues to be higher. Although it is worth noting that we are starting to see momentum begin to fade a little bit, with this high being lower than this high, but this high being lower than this high. So you are starting to get this bearish divergence that is starting to form in the pound. If the 20-day moving average does break, I would look for a retest of this 130 area, which also happens to be the lower Bollinger Band. When we look at the yen, we had a potential bear flag that was set up here. We clearly broke through that on Friday. Then, of course, we had a little bit of a reversal on Monday. And the key thing here is that if you notice, the yen continues to hold in around this 144 level. That continues to be a very important level for the yen, as well as, hovering around this 20-day moving average. We're not really seeing the yen moving much beyond the 20-day moving average, and we're not really seeing the yen move much beyond the 144 region. And so this continues to be a firm area of resistance. Momentum is starting to shift and turn a little bit more bullish. But again, until we start really seeing some sort of meaningful advance beyond this 144 area, we have to assume that the trend is still lower. I mean, certainly from a fundamental macro backdrop, the central banks around the world all seem to be diverging from the BOJ, and it would make sense for the yen to continue to strengthen. The other piece too is that the yen is also seen many times as a flight to safety trade. So if tensions continue to escalate and the flight to safety continues, it's quite possible that you can continue to see the yen strengthening versus the US dollar. It's the same thing with the euro. You can see the yen versus the euro 20-day moving average. We got to the upper Bollinger Band. And so the way I would think about it is, euro yen, you're likely to see a flight to safety out of euro into yen. You're likely to see a flight to safety out of euro into dollar. And so, again, this is sort of the setup. If we break this 20-day moving average, you would expect to see the euro yen drop down to around 155 or so. That would be the area of support. If we move on to copper, I'm sure everyone's been watching copper because of all the news about the stimulus in China. Whether or not that's going to be sufficient to actually do anything, not really sure yet. I think it's estimated to be around 3% of GDP. Doesn't really sound like very much when you're considering the size of the Chinese economy. I think it's around $18 trillion or so, and you're talking about a $600 billion stimulus. It doesn't really seem like very much. It seems like there probably is going to have to be more. But in the meantime, you did see the copper get overbought. You saw us now we're above the upper Bollinger Bands. This is an area that's likely to see some consolidation, I think, still. The 20-day moving average is moving up pretty quickly. So this would be our logical sort of support region would come down to potentially around this area in here, around 450, assuming the 20-day continues to move higher. The upside is pretty limited, I think, at this point. You probably have some strong resistance around this 468 and then around this 473 area, just given, where we are on the Bollinger Band, where we are on the RSI, and these two levels of resistance right here. I think there's potentially a little bit more room to fall at this point than there is for it to rise. Oil, obviously, the big driver here. It looked like oil had broken out of a bear pennant. We were heading lower. $67, $66 remains the really key level here. A break below $66 is going to really start setting up a move back into the upper 50s. And as of this point, 67 continues to hold. It's now been tested 1, 2, about 3 times. Today we actually just about touched it in the morning before any of the news really hit. You can see it happened right around here. We got down to around 66.5. And then, of course, the news about everything going on followed through. And then we could see it broke to the upside. At this point, again, very similar actually to the euro. Here's your trend line on the oil setup. And so if you were to see oil break through this region in here around 72.5, it could potentially come all the way back up to 74.40, which would bring us back into the triangle that had formed and broken down, which then opens a door to potentially moving back into the lower to mid 80s. And so that would be a big turn of events, and it would just again show how important the 66 area is for oil. Again, the tensions in the Middle East certainly make everything a little bit more complex. We're just going to have to continue to take this almost on a day-by-day basis because it could literally change at any moment. But the one thing that is interesting, oil did come up to and just about tested the trend line today, similar to the euro, and that is of note, which maybe suggests there is some really strong levels of resistance in this 71 to 72 area. If you clearly can't break through 72 with all the macro news going on in the world, that's a really bad sign for where oil is going in the future, and it probably means it's going significantly lower. The DAX is still a very odd index to me when we look at it. Just from a fundamental standpoint, I thought it was worth pointing out. One reason why I say the DAX is sort of strange right now is because these are the earnings estimates for 2024, and you can see they've fallen quite a bit from where they had been, call it, in June of 23. They're down some 13% off their highs for 2024, and even when you go out to 2025, these numbers are also showing signs of coming down and down about 8%. So these are pretty significant declines. And so what this is telling us is that the index is rising purely on multiple expansion. And it's possible that, again, the index is just cheap given where it is versus some of its peers. Like in the US, you can see only trading at 12.7 times 2025 numbers. So when you compare that to a metric like the US, trading in the low 20s, the DAX looks awfully cheap at this point. And so that could really explain why you're seeing the DAX continue to outperform despite some of these numbers out of Europe not looking very strong, despite earnings estimates coming down. Overall, the index as a whole isn't really that expensive. And so that could help explain why you're seeing such strength in the DAX at this point. If people have to find a place to put their money, it certainly seems more opportunistic at this point, perhaps than, let's say, the US from a fundamental basis. But again, we're here to do technicals mostly, but it can explain what's happening a little bit. Again, we saw basically we put in a top here. Well, clearly there's a neckline. We broke that. This would imply that perhaps we're going to see a little bit lower prices here on the DAX, maybe over the very, very short term. We can see we already kind of established this potential low, at least from a double top perspective. But again, huge gap to fill here at 18,875. This gap has been filled, and we still have all these gaps all the way down to lower levels, which would suggest that there's still potential here for the DAX to move lower, at least over the short term. But what the fundamentals may be suggesting is that any turn lower in the DAX may be very short-lived, just given, again, where valuations are. So one needs to be very careful with this index at this point, given the way it's been trading, given that it seems very hard to give up gains, and given where it is from a fundamental basis. At least when we look at it from this standpoint, here's your trend line higher. This is still holding as support. When we look at the daily chart also, you can see that there's plenty of room to go to get to the 20-day moving average. This area in here, we're certainly hitting the upper Bollinger Bands. This looks like a nice area to see some consolidation, maybe a pullback, and we'll see how that kind of plays out over the next couple of days. The FTSE continues to be an index that doesn't do much of anything. We're just continuing to go sideways. This has been something that since basically middle of May, we've just been kind of going sideways. And that part, I still think that the FTSE, because of its relationship with commodities and because of how much metals and minings and bankings are in the index, copper still seems to be a fairly good gauge. It's surprising, actually, that you haven't seen the FTSE do a little bit better, given that there are some, links between the UK and Hong Kong, obviously, and you've seen copper prices go much higher, which could be an indication that maybe there's really not all that much strength beneath the surface in the FTSE here. Again, the big level of resistance continues to remain at 8,350, and until you get above that, you really can't be thinking about anything really higher than that, because we have just failed at every attempt so far, despite all the news about China's stimulus, even with copper prices moving up. And here's your short-term trend line at this point. A break of the trend line probably causes a revisit to these lows that were there in the middle of August. When we move over to the NASDAQ had a pretty rough day, falling about 1.4%. Technology stocks were beat up pretty well. When you look at the NASDAQ, you can see we still have this gap to fill. Typically, these type of gaps do get filled. They don't always have to get filled right away, but they do tend to get filled over time. And we're still waiting for this gap to fill at 19,314. If we were to break this level tomorrow, call it today's lows, 19,685, then obviously the next area we're looking for is this gap to fill. Likewise, we have this trend line in place right here, which maybe suggests that we have some room to rise to around 20,000, assuming that we see some sort of short-term bounce, because again, we had a pretty sharp straight line drop at the beginning of the day, and sometimes those are treated as gaps. And with all the economic data coming, it seems likely that you're going to get some sort of implied volatility crush along the way, so you need to be mindful of that potential. The SPX, it looks like maybe we completed some sort of ABCDE pattern. We clearly hit a straight line drop at the open, We clearly came back to and tested this area of the trend line. That didn't really hold. We saw the S&P move back down. We also have this giant gap still to fill down to 5620. I think ultimately that gap still gets filled, and I think ultimately we're going to see that revisited. It's just a matter of when at this point. And we have plenty of room to go all the way back down to 5,400 because we had this weird CPI, post-CBI rally. So at this point, at least from that standpoint, I think there's still further room to the downside. If we look at the upper Bollinger Bands, you can see there's a little bit more room to go, maybe 58.35 or so to the upside. Otherwise, I think that, with the technology sector kind of stalling out, it's making things a little bit more challenging for the S&P. I think NVIDIA is still a big stock, and you need to see NVIDIA advancing really to see the S&P 500 advancing. The Dow today was down just a little bit. It doesn't have as many technology names in it, so it was able to withstand some of the selling pressures. But you can clearly see this 42,150 area is of clear importance. We can see that a break of this region would set up a test of this 41,000. It would set up a test of this area in here around 41,885. There still is gap to fill at 41,460. When we look at it from the upside, if we look at the Bollinger Bands right now, those seem to be the most reliable in terms of projecting upside. You're talking about maybe coming into this 42,800 area if we're able to mount some movement. Although I don't like the way this looks in here. Just something about the pattern and the candlesticks that look not bullish to me. Anyway, I hope you found this helpful, and until next time, have a great week. Bye.